Are you looking forward to controlling your liabilities and convert them into an asset? If yes, then you are in the right spot because we are going to tell you how to handle the cash flow throughout our daily lives. In today's video, we will discuss some extreme information that will help you turn your liabilities into an asset. What is a liability and an asset? Liabilities can be defined simply as anything that will be taking money away from your wallet each month, whereas assets are anything that can help you generate more income. The two most common liabilities people believe are assets are a mortgage and a car payment. How do you convert liabilities to assets? The level of financial intelligence gives you the ability to control cash flow. When you turn that car into a taxi, it starts generating cash for you on a daily basis, putting money into your pocket. The car stops being a liability because it is now a source of income, unlike when the only thing it does is to take money out of your pocket. Instead of this, you can spend your time converting all your liabilities into assets. Yes, it is possible. There is only one simple rule. Find the reasons why your liabilities are more than your assets. Then remove all such reasons. One by one, I explain the reasons and trying to help you remove them. Avoid wasteful people. Some people take advantage of others, like if there are people that whenever they are with you, you end up spending without having anything in return. These people are liabilities and you should try to avoid them. Also, a piece of bad advice from people around, a dubious person, greedy and self-centered person can weaken your cash flow and make you broke. What you should do is disassociate from such people since being around them will make you spend more. Then save the funds you were supposed to spend when you are with them. You can buy shares, create a blog or podcast, buy a car or taxi with the money you have now saved. Now you just turn the liability into an asset. Loan. Taking a loan usually is not a good habit. It increases your liabilities. Your balance sheet is full of loans. You have taken the loan. The loan has increased your liabilities. For removing this reason, you must start to remove your loan as soon as possible. For this, if your job salary is limited to do so, you can do part-time sales work. For example, you can sell my ebook and earn money. Same you can use to remove your loans. With this, you can convert your liabilities into assets. If you will be determined to remove all your loan, you will only see assets in your balance sheet. You do not know the true definition of assets. The true definition of an asset is there is any resource that brings the money in your pocket, even you do work or not. For example, you have a building, you have given it on rent, you have got rent every month. But if you have the building, but you are using its purpose and you did not give it on rent, but you are paying the electricity bill, maintenance cost, and another cost, it will be your liability because it will decrease the value of your capital for spending all such expenses. Do not have the habit of saving and reinvesting. If you do not save and reinvest your profit into business, your business plant will soon die and you will only see the plants of liabilities in it. But if you have intelligence, you can again give water to such plants by making the habit of saving and reinvesting. It will help you convert your liabilities into assets. Only take loans to expand your business. People often see taking a loan as a move or a sign of not living within one's means. Although a loan is a liability, when you take it for the right reason, you can turn it into an asset in a short period. It is okay to take a loan to expand your existing business, to fund a new business because you can pay it back the revenue gotten from the business. But don't take loans for what will not bring profit, things like wedding ceremony, birthday, anniversary, etc. Asset versus liability. If you stopped working today, meaning your salary stopped, from where would money flow into your pocket? Most people I explain this to for the first time reply, nowhere. There'd be no money. An asset may be a rental property that has a positive cash flow. It may be a business in which you invested that gives you the cash flow every year. It could be a stock that pays a dividend. The key is that it is an investment from which you receive money regularly. It provides positive cash flow. On the flip side, a liability is something that takes money from your pocket. So if you stopped working, chances are your car would take money from your pocket each month through car payments, gasoline, and maintenance. Your home would take money from you each month in the form of a mortgage payment, property taxes, insurance, and upkeep. These all provide negative cash flow. The problem is, the majority of people who buy houses do so as a primary residence, not as a rental property. So let's break down what that looks like financially. On a given month of your residence, you need to pay for your mortgage, utilities, maintenance, taxes, insurance, and possibly more. Sometimes these can turn out to be a huge cost. For instance, if you need to replace a roof or your main plumbing line collapses. All of these things that take money out of your pocket. As a rich dad taught, a liability is something that takes money out of your pocket. Many so-called experts will point to things like paying down principal, tax breaks from mortgage interest, and appreciation as reasons why the house is an asset. But paying down principal is simply saving, and savers are losers. The tax breaks from your mortgage do not offset the costs that go out of your pocket each month. And if you're banking on appreciation, you're gambling, as homeowners in the Great Recession painfully discovered. What does it mean to buy assets, not liabilities? Rich people buy assets. Middle-class people buy liabilities which they think are assets, and poor people only have liabilities and expenses. To become rich, stock up your assets column with properties that will generate more returns for you. If you want to be rich, spend your time buying assets. Don't buy that extra car for personal use. Instead, buy a bus or a car for the taxi, which will in turn yield more profit. You can turn your car into an asset by running a taxi business with it. This way, your car will bring you daily returns. Rent out those empty apartments in your house. The house will be a source of income, and funds from the rent will be used to buy other properties. You can make your home an asset by putting it on rent if you have a big house. Sell those clothes you haven't worn for a long time and use the proceeds to buy assets. The clothes aren't generating any income for you and are not useful since you aren't wearing them. Current versus long-term liabilities. Liabilities are also grouped in two categories: current liabilities and long-term liabilities. Current liabilities are those that are due in the next year, while long-term liabilities will not be due until at least a year later. Current liabilities typically represent money owed for operating expenses, such as accounts payable, wages, and taxes. In addition, payments on long-term debt owed in the next year will be listed in current liabilities. For example, if you have a 30-year mortgage on your building, the next year's worth of payments owed will be listed in the current liabilities section, while the remaining balance will be shown as a long-term liability. As a small business owner, one of your most important goals will be to balance your books. That means you need a solid understanding of assets and liabilities in order to make good decisions and evaluate the health of your business. The benefit plan. A traditionally defined benefit plan must satisfy a promise to pay the benefit formula specified in the plan document of the plan sponsor. Accordingly, investment is long-term in nature, with a view to maintaining or growing the asset base and providing retirement payments. In the practice known as liability-driven investing, LDI, managers gauge the liabilities by estimating the duration of benefit payments and their present value. Funding a benefit plan often involves matching variable rate assets with variable rate liabilities, future retirement payments based upon salary growth projections of active workers, and fixed rate assets with fixed rate liabilities, income payments to retirees. As portfolios and liabilities are sensitive to interest rates, strategies such as portfolio immunization and duration matching may be employed to protect portfolios from rate fluctuations. What did you think about how you can turn your liabilities into an asset? Did you learn something? Let us know in the comment section below. Thanks for watching. See you in the next video.